one rental at a time, back with his good boy, Sonny, who will be sitting on my lap so we don't have any of those interruptions this morning. Really quick question if you are new to the channel, a real quick update. We go live at 8 a.m. So in about 29 minutes or so, I will be live on YouTube for about an hour where we ask or answer any of your questions. Questions around real estate, cost of money, what you might do. If you just want to say hi or thank me, I do my best to recognize everyone who leaves a comment. I am still a growing channel, but still small enough where most days, most Saturdays, I can still recognize you, give you a quick shout out. So if you want to go live and spend some time with me, I will be live at 8 a.m. Pacific. I will do that from my desktop so I have more real estate to work with. And we are just going to have some fun together. And then remember, if you were one of my students, we will go live at 9 a.m. in the Facebook group, much smaller crowd, answering any of your specific questions. So let's get on to the daily financial news. Something that we have to watch. This is something that I told you was coming. It is now here. We must watch the consumer. We must watch what the consumer is thinking, and we must watch what the consumer is doing. These are important variables because they don't always correlate. We just had a shockingly bad consumer sentiment number. Thursday's big number of CPI, 7.5%, was the big number of the week. If it wasn't a CPI number reading this week, consumer sentiment would have been the big number, and it came out yesterday. It was shockingly bad. It came out at 61.7. That number means nothing to you unless I can put it in context for you. First off, January reading was 67.2. So, okay, we fell 10, 11%. The expectation was 67. So now we have a huge, gigantic miss. Lastly, it was the worst reading since October 2011. Folks, if you don't remember 2011, it was, what's the technical term? Yucky. So this just goes to show you that I do believe that a recession is in the offing. In fact, Q1 might be the start because, again, to get a technical recession, you need 2 negative quarters of GDP growth. The report highlights that we all expect inflation to be above 5% throughout the year. We all expect to fall behind. This should hurt to read. Yes, you are getting a 5% wage increase, but you're suffering 7.5% and arguably 12, 13, 14, 15% inflation. Not good. And frankly, people are finally recognizing across the board that they have very little or less confidence in the government to help. Historically, at least the last 18 or 24 months, maybe even 36 or 48 months, it has been very bipolar. If you were red, you liked one. If you were blue, you liked the other. What we saw in this report is there are now cracks in this. And it makes sense. We all pay the same gas. We all buy the same food. We all see what's going on. It is, I suspect November, we're going to be angry. And an angry voter is not typically good for incumbents. Incumbents of all ilk, size, and party. We frankly should be angry and upset. But when we look at consumer sentiment, remember, it's sentiment. It's an opinion. It is at best a forward indicator of behavior. At best. It's one of those leading indicators that can, on occasion, be a significant head fake. I don't think it is this time. I think what we are seeing right now is consumers, at least at the margin, retreat. We are less confident about the future, and a less confident consumer doesn't buy big things and doesn't buy discretionary. However, we need validation. The American consumer loves to spend. They spend when they're happy, they spend when they're upset. So what we are going to be looking forward to later this month is retail sales. I am very interested in retail sales in January. It will either be validation of consumer sentiment quickly turning, or prove that, yeah, you talk a good game, but you are still spending like a madman. Retail sales going to be a big number later this month. Interesting articles. If you know, been watching this channel probably for 4 months or so, you know I planted the seed that the Fed will have to raise rates 50 basis points. I did that 4 months ago. Now it went from 0% chance to 0 to 5 to 24 to 99%. I just realized my light's not on. Let's see what this does. Oh, look at that. You can see me now. I'm sorry. Small details. And now 99% chance. As I mentioned Thursday, after the CPI reading, I was going to be more confident about a 75 basis point than 25. Lo and behold, odds of a 75 basis points are now being priced in at 10%. Now, let's be clear. I do not see it. It just, no, I don't see it. In fact, we actually, what a lot of people watching the Fed today don't realize is you have been conditioned to think the Fed must and only act at Fed meetings, which I think the next one is March 10th or 14th or something. They don't have to. Instead of a 75 basis points move in March, if that's what they wanted, I suspect they would just move early. They can do it. Right now, they're telling us that they're going to end the taper in March. They could end it Monday, right? They could stop buying Monday if they wanted. They could raise rates Monday. Shoot, they could raise rates today if they wanted. I believe the Fed needs to shock the market. 75 basis points would certainly shock the market. A early move would shock the market. Stopping the taper early would shock the market. But let's be real. I have zero confidence in Powell doing any of those things. In fact, I've often thought that Powell would have to be a mini Volcker just to do a half a point, which I think is the right move. I just don't think Powell has the backbone. He wants to communicate and tell the world what is coming so the market doesn't freak out. In the end, I will go back to the fact that I think the Fed must shock the market. If the Fed does not shock the market, we will have a recession. We just will. This death by 1,000 cuts that you and I are feeling every day when we fill up our tank or go to the grocery store. The Fed could shock the market. Yes, Wall Street would throw up. Yes, stocks would fall down, but maybe, just maybe, we could avoid a recession. He doesn't have the backbone, the stones. He is not Paul Volcker, although he frankly needs to be. This is not going to be good. So could a emergency move happen before March? Yes, it could. Will it? I don't think so. Could the Fed end the taper early? They should, right? The first rule of hole digging, if you are in a hole, debt, anything, stop digging. The Fed should have stopped last meeting. They didn't. So I don't see anything. I see a half a point like I've seen for 4 months. My opinion hasn't changed. We'll know in 5 or 6 weeks. Looks like Russia is gearing up to attack or invade or whatever Ukraine. What does this mean? Well, I can only talk about what it means, and we saw this on Friday. First and foremost, oil will go up. Remember what I told you on Monday? I expected the 10-year note to exceed 2%. Check, that happened. And on Monday, I said I expect oil to be over 100 this month. It may happen. Folks, my videos are recorded. I delete nothing. Go back and look at Monday's video and see that I called for both of those things. We're running pretty good on the daily financial news. I also want to remind you, we had a talk about bear markets about a month ago. I want to remind you there are two traditional triggers for bear markets. One, the Fed reverses course and they begin a tightening cycle. Number two, war. Let that sink in. What are we facing right now? What could happen if we get one and two? Yeah, that ought to be interesting. A couple other things that I caught today. What else do I want to talk about? Again, the Fed is obviously behind the curve. A lot of articles about that. The Fed has adopted Ben Bernanke's style, where they will talk, communicate, chide, cajole, just try to get the market to understand where they're going so no one's surprised. That takes work. More importantly, it takes time. And you and I, your neighbor, your family, are paying the price every day. And again, if they continue to do this to help Wall Street, the American consumer gets hurt and we will have a recession and it will probably be unkind. Looks like Elon Musk is out continuing to prod Biden. Apparently, those two do not like each other. That goes both ways, near as I can tell. But Elon Musk is out saying that, hey, we just went over $30 trillion in U.S. debt, government debt, which is actually $60 trillion. What I didn't realize, and shout out Elon Musk for just putting it in plain black and white, that debt basically means that you and I, every adult, so everyone over 18, owes $240,000. Ouch. Ouch. But oh, by the way, the average adult has a median net worth. So the middle, you have to watch average versus median. Median net worth of $45K. Let me just tell you this. If your net worth's $45K and you've got debt of $240, you're probably not getting a home loan. You're probably a high-risk borrower. Not good. What this just really goes to show me is just another reminder that free money is never free. I know it feels good when you get it, but free money is never free, and we are paying the price right now. We all are paying the price. Saw an interesting article about Joe Burrow. It's okay if you don't know who he is. He is the quarterback, the starting quarterback for the Cincinnati Bengals, who will be playing in the Super Bowl tomorrow. What was interesting is this young man is in his early 20s, and he says that confidence might be the most important trait. I found this interesting because what I try to do with my course, How to Get Started One Rental at a Time, is I try to show you how to build confidence in you. Focus, buy box, daily discipline, grow your network, get around amazing people in the private Facebook group. I agree. Giving you the tools to build confidence in yourself is a huge goal. But here's the deal. It takes work. You have to do the work. You have to do the work. So again, I thought that was interesting. It's official, folks. The 30-year mortgage is over 4%. If you've been watching one of my experts, Greg Dickerson and I, he has an awesome playlist on this channel. We have been debating, is 4% the number that makes housing retreat? Greg believes that 4% is the magic number. I have often said, are you kidding me? That's not normal. We've had an abnormal rate environment. It might be 5 or 6%. The good news is we will find out in about 6 to 8 weeks because we are over 4%. Near as I can tell, the market is still on fire. So we will see where this goes. Lastly, I guess there's 2 more points. One, I had a video yesterday talking about Fed stress test and the commercial market. I want to clear some questions up. I believe the most pain will happen in the office and retail sectors. We have assets that aren't performing, and we will need to start to do a cleansing period, and especially office buildings. Office buildings are not going to see the same occupancy. I've seen tech companies around here running off leases, which is just like we will let them go and not release the building. I believe there will be some opportunity in office and retail. I do not think next year or this year will be apartments. I think that pain is a couple of years ahead. And then finally saw an article. It's often said, how much does a homeowner spend on maintenance? What I saw in the article is the average spends $3,018. There's often this debate between home ownership and becoming a renter, and renters don't do maintenance and all of that. Well, I finally got a number that I don't remember seeing before, and it was 3,018 bucks, or about 250 bucks a month on maintenance. So lots of stuff going on. Remember, we are going to go live for about 60 minutes to take your questions and answers. Come along, see what's going on, ask questions, leave comments, like, subscribe, all of those great things. Have fun. Take care of yourself. Bye bye.